In 2014, Fidelity set out to determine what common characteristics its best performing accounts possessed. Was it education? Perhaps its clients with the most advanced degrees or those who attended the most prestigious universities produced the highest returns. Was gender important? What about age and background? Perhaps those who lived in the most expensive zip codes, who had the finest investment advisors, performed the best. After reviewing the returns of its customers from 2003 to 2013, Fidelity found something totally astonishing. Their top performing accounts did indeed have one thing in common. The accounts that sported the highest returns had owners who were dead. That's right, the highest performing accounts were those whose owners had passed on to the other side. Fidelity did find a few extremely well-performing accounts whose owners were still alive, but their accounts had been inactive for years. When contacted, these customers were often confused, not remembering they even had an account with Fidelity. Most had opened one years before and forgot about it after they moved or started a family. Many had opened accounts in the preceding decades when they worked for a previous employer. So how can this be? What's going on here? Why is it that the dead, or those that don't even remember opening their accounts, beat the pants off of those who choose to monitor the market on a daily basis? There is a few things that must be discussed for us to fully understand why these zombie accounts totally outperformed Fidelity's other users. First is emotions. Most traders just can't stick to a plan. Fear or greed gets involved, and they find themselves making totally irrational decisions. This leads them to literally buy at the top or sell at the bottom. When they see a stock rising and hear about all the money their friends are making, they just can't step away. They get caught up in the excitement and buy an extended stock just as it's about to U-turn. Conversely, when they hear all the gloom and doom on the news, the sky is falling, eventually, even if they own a stock they really believe in, they get to the point where they just can't take it anymore. When everything seems as bad as possible, they dump all their shares, only to realize they did so at the exact worst possible moment. The highest performing accounts at Fidelity did not have to deal with any of these. Because the owners were dead or completely inactive, they had no emotions involved in their decisions. And without greed or fear to impact their decisions, they just let the market do its thing. The second aspect of these high performers was the fact that they gave the market time. Big moves take time to develop. Sadly, most traders just don't have this type of patience. They just can't sit tight. They must have everything right away. They think, if I can pull up my favorite song or video on YouTube right away, why can't I make my trading profits come as quickly? But the market doesn't behave like this. What happens to these type of action junkies is that they tear their accounts up trying to catch each and every little move while totally missing the major move that is happening over the long term. It's like someone who goes to the beach and is so focused on a grain of sand that they miss the entire magnificent view that lay right before them. They miss the big picture, and it is this big picture or big move that makes the big money. Consider what Jesse Livermore once remarked. I think it was a long step forward in my trading education when I realized at last that when old Mr. Partridge kept on telling the other customers, well, you know this is a bull market, he really meant to tell them that the big money was not in the individual fluctuations, but in the main movements. That is, not in reading the tape, but in sizing up the entire market and its trend. Instead of getting so caught up in the minute-to-minute action, pull yourself away from the monitor so you can get a view of what's going on in a big way. When you pull yourself back and look at the long-term trend of the stock market, you can clearly see that despite its ebbs and flows, the general long-term trend is towards the upside. Like Jesse Livermore, it may be a long step forward when you realize it is the main movements and not the individual fluctuations that lead to the big money. Finally, the Fidelity study shows the amazing power of compounding your money. Albert Einstein once remarked, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." Take this as an example. Let's say someone starts out with $10,000. They put it in the stock market and receive an 8% annual return on average. They set their account aside and forget about it. After 1 year, they'd have $10,800. After 5, their account would have grown to $14,693.28. After 10, they'd be up to $21,589.25. If they could make it to 20 years, they would have over $46,000. At 50 years, they would have close to $500,000 or over $469,000. If they could make it to 70 years, that initial $10,000, which they never touched and never added to, would have grown to over $2 million. While these numbers sound astonishing, it's math that you can quickly do online. The key to understanding this power is to realize that each year you are compounding a larger amount of money. At first, you are only getting 8% of $10,000 or $800 in interest. However, as your money grows, you are now getting interest on your interest. After 20 years, you are getting interest on over $40,000. Those 8% interest payments look better and better as the years roll by. While I would never advocate blindly buying and holding a stock, there are some lessons that we can learn from these zombie accounts. By giving their stocks time to move and by taking the emotion out of their trading, these accounts were able to use the power of compound interest to produce extraordinary returns. The next time you find yourself staring at your phone to check every minor fluctuation or start leaning into your monitor to see each and every tick, think about that time when zombies beat the market. Fidelity did indeed find what they were looking for. They just didn't realize that the owners, like the returns, were out of this world.